Despite the concerted efforts made by the Central Bank of Nigeria to revive the country's economy from the adverse effect caused by COVID-19 pandemic, the economy slipped into another recession as GDP contracted in Q2 and Q3 2020, causing inflation to rise to a 33-month high of 14.89% year-on-year in November. As President Buhari signs the 2021 budget into law, economic experts are of the view that the budget cannot serve as a basis for driving economic growth in the year 2020, going by the deficit of about 5.2 trillion naira, which is approximately 3.64% of the country's GDP. However, there are projections that the country's GDP will rebound to 1.7% to 2.0%, driven by increased economic activities and some improvements in the oil market, which was supported by the World Bank projection of 5% growth for emerging markets and developing economies in 2021, resulting to a speedy economic growth recovery from Nigeria and other African countries. I have joining me live via Skype to give a broad analysis of our topic of discuss. He is a senior economist and head of research and strategy at Greenwich Merchant Bank, Mr. Ayodeji Ebo. Mr. Ayodeji, thank you very much for your time and a happy new year to you.
Yeah, happy new year and thanks for having me.
Yes, I want to start with the figures we've had in from the likes of IMF and World Bank. It's been one after the other, and everyone has been saying, what do we really flow with? What do you think, before we move on, what do you think about growth rate? Some are saying first quarter 2021 might be our way out. With the second wave of COVID-19, that seems not to be visible. What are your projections for 2021 in its totality?
Okay, thank you. We were expecting that we should begin to see some form of respite from the second quarter. And part of what would also help push that up or achieve that is that when you look at it on a base level, Q2 was significantly down 6.1% in 2020. And by the time you are looking at the nominal GDP, on a year-on-year basis, you would see, or you also even want to compare it based on real GDP on a year-on-year basis, you would discover that we may likely move to the positive. Then moving into Q3, Q4, we expect that if this of the pandemic is not prolonged and oil prices does not dip further, business activity should pick up significantly towards the end of third quarter, and that should help push up the expectation and also business activity and the positive growth rate we should expect in Q3 and Q4.
If we are to expect this, I want to remind you that Nigerians have had a lot to grapple with. We have a lot in our plate at the moment. We have subsidy issues where we know that the price of PMS will continue to increase as the price of crude continues to go up. Happily today is about $54 or something around $55. We also have issues around electricity tariff to grapple with as Nigerians. And on the other side, the discos are saying they want a cost-reflective tariff for us to have steady power supply. Now, putting all of this together, where do you see the average man, the average Nigerian? Where do we play in all of this?
Yes, it's really sad that most of these prices of most of these items are going up amidst when you now have a stagnant income. So when you look at looking at how those parameters feed into inflation, you can see that inflation has been up significantly, expected to cross 15% even in December, and maybe on a base effect may moderate slightly. But if you now look at the purchasing power of the average Nigerian has continued to be squeezed on a daily basis, which would also have its impact on the demand. And once demand is also reducing for most of the producers, they will also cut down on their production. And that is how, once production is reduced, that will lead to downsizing, and you'll see how all those things are interlinked. So it's not really an interesting time for Nigerians. And even if we look at what government is also trying to do, government, when you look at federal budget, because most time we focus more on federal budget and we don't look at what the various state budgets have also planned to spend. If you look at the federal budget, which is the one we easily have the figures, 13.6 trillion, it's still very minute compared to the size of the economy. And in terms of how the impact that would get from that is really also very low. Yes, government is trying to come up with different palliative measures and also cash transfer measures, but it's also beyond this. You look at the budget, capital expenditure thankfully has been increased from 3.6 to 1.1 trillion. That's the approved budget. But this is still very minute looking at the infrastructure deficit and a lot of the gap. So there needs to be a framework that would provide confidence for private investors, especially whether domestic or foreign investors, to come and support. The revenue sources is very constrained. We know how OPEC quota is also impacting on the oil revenue. Yes, government is projecting to get about 25% from oil, but we all know that when you look at actual, most times, the actual oil revenue or as a proportion of total revenue is always as high as 50%, which is always significant. So whatever happens will cause a distortion. So it's really, getting back to your point, is that it's really a tough time for Nigerians, and there need to be policies. Yes, government is trying its best. There needs to be more to create that framework, that enabling environment is more critical. It's not just about the cash transfer or the spending, but if we have that enabling environment, and the African Continental Free Trade Zone has just opened up. But when you look at how the economy is structured, how are we positioned to take advantage of that so that we can increase our capacity to earn, such that it would also boost business activity in the country? These are the avenues where Nigerians can boost their earning capacity and as a result increase their purchasing power, which would also boost demand in the economy.
A big question you asked there, Mr. Ebo, talking about how we can take advantage of the African Continental Free Trade Agreement. Because in paper, it looks very good, but actually with what we have on ground, a country of more than 200 million people. I think that's a topic for another day. If we decide to move to that, we'll shift away from, but it's something very important. Now, the central bank has been trying as much as possible to shore up liquidity, particularly in the forex market now. That's where I want us to move into. As we move in 2021, do you think the bank can continue to sustain this model? Because some say it's not sustainable.
Okay, based on what is really happening, we know, because most of the inflows from FX inflow comes from oil, and as a result, that reduced the ability of the CBN to defend the naira. But with what the oil price going up is also going to provide some form of comfort for the CBN, and also you also recall that recently the $1.5 billion World Bank loan would also help provide some form of support for the external reserves that the CBN has been using to intervene. We believe that even as the economy also picks up and we begin to see some form of stability in the economy, we may begin to get more inflows. The PIB, that's the Petroleum Import Bill, should, if it's also passed if it's also passed within the first quarter or second quarter, we may also be able to attract more FX inflow in form of investment, which is critically what we need. CBN is trying to manage the external reserves to not to go below a certain level. There are some of the moves that CBN has also made. If you look at it based on remittances in diaspora, we believe that within the short to medium term, we should begin to see also that impact. When you look at annual remittances for Nigeria, it's above $20 billion, which will provide enough support. So I think what CBN is also trying to do is knows that Nigeria is import dependent, and any major shift would also impact and feed into inflation. Most businesses now are getting most of their dollars from the parallel market, and we believe that once we begin to see the impact of the new policy on remittances, that should also increase the flow into the dollar flow into that area. And as we progress, we need to begin to see some form of convergence, because we need to close that gap as much as we can. We can avoid any major round tripping or speculation on the greenback.
Mr. Ebo, now let's look at sectors that are yet to pick up despite we're already in the second wave of COVID-19. And that is also something that analysts have agreed that will slow growth. Because, of course, there are some restrictions, still some lockdowns globally, and we still see the figures rising, even Nigeria as at today. Now, aviation is one of these sectors, tourism, some small businesses. Now, would you say the fiscal side and the monetary side are doing well to help cushion the effect of all of this that we faced in 2020? And as it is, like even the PDF, that's the presidential task force came out openly to say, PTF, that January will be a very, very a serious month. We have to be serious. It's going to be, a lot of issues will pop up with regards to COVID-19. Now, what do you think? Are they doing enough to cushion this effect? Because a lot needs to be done. We hear what's happening in the US, what's been happening in the UK.
Okay, thanks. I think the federal government is trying its best, but they are also limited based on resources. And that is why there's the need to see how private sector support can help boost. They are limited based on available resources, and whatever happens to oil impact on the ability to spend. Even if you look at the capital expenditure of 4.1 trillion, if we're unable to meet up with our revenue target of about 7.8 trillion most times, then also we know borrowings, that's for domestic borrowing about 3.6 trillion. If we're unable to perhaps go below that, most times it's always the capital expenditure that's always at the receiving end that we're unable to implement. And that is what would create that enabling environment, ease of doing business, because you know how the Nigerian economy is driven, the SMEs. So we need to be able to see how their services, goods and services are very competitive by reducing their distribution cost, their production cost, and that will make it very, very competitive. Yeah, you narrow down to the aviation, the tourism and hospitality sector. Yes, they are really very impacted. They've been very impacted. And if we look at what their contribution is to GDP, I think it's still very minute. What government is trying to do, if you pick the agricultural sector that contributes over 20%, you look at the new Finance Act of 2020, you will discover that for the SMEs that account for a major part of that sector, they are trying to provide some form of relief and encourage production or investment within that space. So you have relief or pioneer status of up to 4 years and can be increased by another 2 years. That would also encourage investment and would have stronger multiplier effects on the economy. You also, another sector that I believe government should focus more is the manufacturing, then will come to trade. The manufacturing sector is critical. We need to begin to add value to a lot of our resources rather than continue to export raw materials and produce them. If you are produce them in those countries and import them back, that means that we are funding, we are creating employment for other countries at the expense of Nigeria. And so we need to also focus and be deliberate. There needs to be a roadmap, a developmental plan, long-term plan on how to grow the manufacturing sector such that we can add value. I know this discussion is not about the after, but it's also good to mention government needs to create that framework and increase their awareness. When you speak to a lot of even the informal sector, the SMEs, they are not aware of how to assess on how they can take advantage of this new trade zone, this market. I'll call it a market that has opened, and there need to be awareness within that space. And as a result, that would boost production within the manufacturing sector. And government can introduce some incentive. Yes, government should try to move away from subsidizing consumptions. Those we see in the power, power sector. We are not sure if with the increase in the crude oil prices now, we're not sure if government will be able to sustain the removal of subsidy on PMS. But that is like subsidizing consumption. We need to focus on subsidizing production. Most of these companies, when they set up them incentive, encourage them such that their goods are competitive, and over time you can roll back and you would gain that fund or that savings in the long run, or what I call that subsidy you are giving to them now. In the long run, when they begin to pay in form of taxes, you will gain that in the long run.
Always brilliant talking to you. Before I let you go, Mr. Ayo, let's just round up on this note. Recovery is key. And we've heard about what kind of recovery we would have. A lot of analysts have come up with a kind of recovery. It's going to be U, it's going to be V, it's going to be... What do you make? What are you thinking? What kind of recovery do you see? Let's end it up on that note.
Yeah, I think what we see is going to be a U-shaped recovery. It's going to be gradual. We don't expect any major sharp recovery in the economy. We're already in Q1, and like you rightly mentioned, the second wave of COVID-19 is also impacting on business, and we are hoping that there will not be any major lockdown, and that would be very drastic, and that would have significant negative impact on the economy.
Mr. Ayo, thank you very much for your time. Senior Economist, Head of Research and Strategy at Greenwich Merchant Bank. Thank you very much for spending your Monday afternoon with us on Business Nigeria. I appreciate it.
Always my pleasure. Thank you.